difference with Annex Wealth Management? If you like to look up investment terms, Investopedia is a good source. It's got dictionaries, advice, reviews, ratings, comparisons. It's got a long section on squeezes. You might have heard of profit squeezes, credit squeezes, short squeezes, long squeezes, bear squeezes. Investopedia says squeeze situations often accompanied by loops that make a bad situation worse. Surrender squeeze might be new to you, certainly not new to my guests. Let's say hello to Amy Kiiskila, wealth strategist, estate planning attorney at Annex Wealth Management. Hey, Amy.
Hey, Danny.
Also joining us, Brandon Lehman, CFP, wealth manager and director of branch development. Welcome back, Brandon.
Danny.
Surrender squeeze. That's not where that weird uncle gets a hold of you and he doesn't let go. It's actually worse. What is it?
It certainly can be worse. What we're talking about here are the potential consequences when taking a loan against a life insurance policy. So if we take a step back for some context, many types of permanent life insurance will allow that owner of the policy to borrow against the policy. So like other types of loans where we might be familiar with, the loan's going to charge interest. It's also going to have collateral. In this case, the cash value of the life insurance policy provides the collateral for the policy loan. Unlike other type of loans, you don't necessarily have to pay the loan back on a set schedule. If you don't pay it back, there's some flexibility. So let's say you die and you haven't paid the loan back. Life insurance company is just going to take a portion of those proceeds to pay the loan back.
Yeah, and this is something that we tend to see in somebody who bought a policy a long time ago, right? So they tend to be larger policies. So you look at your business owners who had started a business and they needed that life insurance when they started. Maybe some of the executives or doctors. A big one has been doctors. Doctors have these policies where they have very large policies they took out maybe when they were residents or they were going through that start of their career. That's where you tend to see this. It's not in every policy. It's not something that's talked about in broad context, but it does exist. Those just happen to be some areas where we have particularly seen it as of late.
So now let's get to the surrender squeeze part of it. So let's say I took that loan against my policy, and let's say I didn't do anything to pay it back. I didn't pay the interest, didn't pay any of the principal. That interest just simply gets added to the balance each year. So now if that loan balance starts to get too high, it's going to bump up against that cash value in the policy. And if it gets high enough, the life insurance company is going to say, well, that policy has now lapsed. They'll surrender the policy. They take that remaining cash value then to pay off the loan. So I don't get any of the cash out because I already took it in the form of the loan. But what I might get at the end of the year is a nice tax bill. So when there's gain in a policy, to the extent that that cash value exceeds the basis, which is essentially the premiums that you've paid, it's going to have gain. And that gain should be ordinary income.
And again, it was sold to them because life insurance does fit a need depending on your situation, all that. It's been sold to them and they've been said, you can take these loans, but then as time goes on, you notice that folks forget about it. Life insurance has an opportunity and it works out well sometimes where it can pay it for itself, right? The dividends are paying for that loan. Well, if you forget about it, and as Amy alluded to, if that loan's too large, things can get a little different.
If we were to go back in time to when the client was presented with this type of insurance proposition, what would our counterpoint or our suggestion be that might be more beneficial down the road, like as in now?
You have to look at it and look to the future. What makes the most sense? What is the purpose of the policy? What are you getting this for? Is it because you want to use it as a retirement vehicle? Well, then you have to take a step back and say, okay, well, what type of retirement vehicle? What are the other vehicles that we're utilizing? And make sure that the insurance that you're getting matches the needs you have, not just now, but in the future. And understand that nothing from the insurance side is necessarily guaranteed. I say that word not lightly, but there's just so many moving parts and you want to factor that into the overall plan.
That's right. And that's a great way to start is what's the purpose of life insurance? It's essentially a pile of cash at death. So really understanding why you need that pile of cash is very important. Brandon, you referenced doctors, business owners who often might have these permanent insurance policies. Well, they often need the cash to pay estate taxes or to pay off other debts at death. And by taking that policy loan, you might be jeopardizing the ability to have that death benefit at the time when you really need it. So it really does start with a great comprehensive financial plan and understanding what all of your needs are across your lifetime and then really matching the right products and solutions to meet those needs.
Well, and it's key to understand what you're doing. Understand what that loan means because this is a loan. This is just like going to the bank and getting a loan. And they'll say, well, you're taking a loan from yourself, but you're taking a loan from the the company that issued the policy. You're not taking a loan from yourself. So now you're paying interest back to them. And a lot of times, as we've seen, Amy and I, specifically in conversations we've had, folks haven't paid it back. And that's where all of a sudden they look at cash value and they say, well, we have $100,000 in cash value. And you're like, your surrender value is $3,000.
And by the way, these things are not cheap, are they?
No, not by any stretch. Some of these policies can be very expensive. And when I say very, tens of thousands of dollars.
How can we help folks with situations like this before they get into it?
I think it's important to sit down and utilize a financial advisor, a team like we have here at Annex, because it's not just myself and Amy meeting with folks, right? You have the financial planning team, you have the tax team, you bring all these teams together and they can look at it and give you an objective opinion, because we can't sell product, an objective opinion on what's going on.
For investment, retirement planning, tax planning, and estate planning, we do it as a fee-only fiduciary. Know the difference. Website, annexwealth.com. Click that Get Started button. Brandon Lehman, CFP, Wealth Manager and Director of Branch Development. Thanks for joining us.
Danny.
Amy Kiiskila, Wealth Strategist and Estate Planning Attorney at Annex Wealth Management. Thank you for joining us.
Thank you.